On Monday, NASDAQ futures ripped higher right at the open. The spark was a weekend headline featuring Donald Trump discussing productive ceasefire talks. Those talks specifically centered around Iran. The market had been pricing in heavy conflict risk in the Middle East all week, so the sudden prospect of de-escalation forced an immediate volatile reaction. This massive rally was fueled by trapped traders panic buying to close out bad short positions, lacking any support from fresh institutional investment. This chart shows the daily change in open interest, which is the total number of outstanding derivative contracts held by market participants. On Monday, open interest plummeted by 11,850 contracts. The fuel for that morning rally was completely exhausted by the close. By Tuesday morning, the June NASDAQ contract opened at 24,417.25. It was sitting directly inside the prior day's range, completely unsupported by natural buyers. Propping a market up on exiting shorts creates a dangerous vacuum. Once covering stops, price waits for a catalyst to trigger a collapse. Mapping the strict trading boundaries established during the overnight Asia and London sessions reveals how institutions set the Tuesday trap. This plots overnight data. The London ceiling sits at 24,507. After the New York Open, buyers failed to push past it. Institutions refused these premium prices. Down at the 24,193.50 Asia floor, a massive cluster of retail stop-loss orders rests directly below. Because smart money found no value at the ceiling, they reversed direction to hunt that vulnerable pocket of orders resting under the floor. The spark for that reversal arrived at 9:45 a.m. Eastern with the release of the S&P Global Services PMI. PMI stands for Purchasing Managers Index, a survey tracking the economic health of the services sector. The reading came in hot at 52.4. Beneath that headline number, input costs and selling prices were rising at the fastest pace since August. Sticky inflation conflicts with market hopes for Federal Reserve interest rate cuts. Because tech stocks rely on lower borrowing costs for growth, this data instantly pressured the NASDAQ. By 11:30 a.m., that pressure crystallized. A massive, organized sell auction overpowered the market and forced the price sharply lower. Traders call this a displacement move. It is a rapid, purposeful sequence of selling designed to permanently break the existing market structure. The preliminary support level at 24,320 didn't even cause a moment of hesitation. Sellers completely obliterated it and kept pushing lower. This chart shows the damage. Price plunged through the 24,193 floor, bottoming at exactly 24,108.5 to sweep up those stop-loss orders. Institutions engineer these downward spikes on purpose, triggering retail sell orders to fill their massive buy orders at discounted prices. Institutions weaponize these macroeconomic data releases as physical tools to shatter support lines and harvest retail liquidity. After sweeping the lows, the NASDAQ managed a weak recovery, ultimately settling the session at 24,284.25. This chart puts that settlement into context. The 24,284 price tag sits dead center in a contested range, signaling a perfectly neutral two-sided battleground. To confirm a bullish recovery next session, buyers must push the price up and achieve a clean, sustained close above the 24,680 resistance zone. Any subsequent failure below today's 24,108 low opens a trapdoor to much deeper sell-off zones. Trading inside a choppy, neutral box without a plan is a guaranteed way to lose capital. True professionals wait on the sidelines for a definitive break of the established boundaries.